revise Ind AS to inventories. Okay. As we know, this standard is applicable to all inventories except financial instruments and biological assets related to agricultural activity and agricultural produce at the point of harvest. However, agricultural produce after the point of harvest are covered by Ind AS 2 only, that we are going to discuss, right? And inventories definitions, as we know, they are assets in the form of finished goods held by the entity for sale in the ordinary course of business, are work in progress in manufacturing process, are raw material to be consumed in production process, are used for providing services, right? This is inventory definition. Now coming to the core area of the standard, measurement principles. What standard is saying? Inventories shall be measured at lower of cost and net realizable value. In order to conclude this, we need to first calculate the cost. After that, we should estimate the net realizable value. Okay. Thereafter, we can compare. Resultantly, we will get to know which amount is lower. Accordingly, we will account. Right. Let's discuss one by one. Cost of inventories. Cost of inventories includes what? Purchase cost, conversion cost, and other costs incurred to bring the inventory to the present condition and location. Let's discuss this one by one. Cost of purchase of inventories. Purchase cost, purchase price included. Import duties and taxes. Import duties and taxes only if they are non-refundable. If they are refundable in nature, we should not add. Transportation and handling costs, yes, we can add. And other costs that are directly related to purchase of finished goods or raw material, and even for getting any services also we can add. Trade discounts and rebates and any other similar items we can reduce. Clear? And coming to the next one, cost of conversion. Means what? Cost incurred to convert the material into finished goods, and that cost is directly related to our units of production. That also we can add to the cost of inventory. Direct material, direct labor, and other costs, and indirect expenses such as fixed production overheads and variable production overheads, that can also be allocated on systematic basis. Variable production overheads directly change with our units of production, correct? So standard is saying that allocate the variable production overheads on actual basis. And coming to the fixed production overheads, I can say fixed cost. Fixed cost remains constant regardless the volume of production, correct? So what the standard is saying that allocate the fixed cost on the basis of either normal capacity or actual production, whichever is higher. For suppose, if our normal capacity is 5 lakh units, our actual output is also 5 lakh units. Allocate on the basis of normal capacity, fixed cost divided by normal capacity. So that per unit value we will get now, you multiply with the actual output. Similarly, if our actual output is 3 lakh units, our normal capacity is 5 lakh units. In this case also, allocate the fixed cost on the basis of normal capacity. What's our fixed cost divided by our normal capacity? How much? 5 lakh units. We will get per unit value. You multiply the 3 lakh output with that per unit value. You will get some amount. And the remaining fixed cost, if any, that you charge to profit and loss account as an expense. For suppose, if our actual output is 7 lakh, normal capacity is 5 lakh. In this case, allocate the fixed cost on the basis of actual output. Fixed cost divided by actual output. You will get the per unit value. Allocate the same to the actual output. So this is what the standard is saying. Clear? And next one is, what is that? Other cost, correct? Yeah, this one, other cost. We discussed cost of purchase and conversion cost. And next one is other cost. Cost incurred to bring the inventory to their present condition and present location. I can say this is a residual category. If that is in directly relation to our present inventory to get the present location in and present condition, we can add it. Standard has given a few illustration examples that we should not add to the cost of inventory. We should charge to profit and loss account. What they are? Abnormal cost, abnormal loss, be it a material cost or labor cost or any other overhead cost. If they are abnormal in nature, you don't add. Charge to profit and loss account as an expense. Storage cost also. Storage cost also recognized in P&L account as an expense. Should not add. However, if that storage process is also integral part of manufacturing process, in that case we can add to the cost of inventory. Let's say example, pickles like mango, tomato, amla, or any other pickles, and in case of wines, whiskey, in that processes, Storage is an integral part of manufacturing process, correct? In that cases, include the storage cost to the cost of inventory. Should not charge to profit and loss account as an expense, right? And next one is administration overheads and selling and distribution overheads charged to profit and loss account as an expense. Borrowing cost. If it is allowed by Ind AS 23 to include to the cost of inventory, include it. Otherwise, charge to profit and loss account as an expense. And next one is if we acquire inventory on deferred settlement terms. Deferred settlement terms means what, sir? It is an abnormal credit period. In that case, whatever the consideration we are going to pay to the vendor includes interest cost. So that interest cost we should not add to the cost of inventory. That interest cost should be recognized in profit and loss account as an expense. Clear? So with this, we determined the cost of inventory by adding cost of purchase, cost of conversion, and other costs. Right? Now we know the cost of inventory. So in special cases, how to determine the cost? For example, if our product is harvested agricultural produce, so what is the cost? Let's assume this is point of harvest. So till now, Ind AS 41 applicable, and after this Ind AS 2 is applicable. Correct? As per Ind AS 41, we measure the harvested agricultural produce at fair value less cost to sell. Once the harvest is completed, it will become inventory, and that should be accounted as per Ind AS 2. At what amount, sir? Fair value less cost to sell only. That fair value less cost to sell becomes cost of that agricultural produce as per Ind AS 2. Clear? And next one is allocation of cost to the main products and byproducts. For suppose, if our manufacturing process results to only main products, in that case, if the cost we have incurred can be separately identifiable for each product, we can take that separate cost. If we cannot identify the cost specific to each product, in that case, allocate that cost on the basis of relative sales value of that main products. Clear? Now, second one. If our manufacturing process results into main products as well as joint products, main products as well as byproducts. In that case, estimate the net realizable value of byproducts, because byproducts are usually immaterial in nature. So that NRV reduce from the total cost, that net amount allocate to the main products on the basis of their relative sales value. Clear? If the byproduct is also material, treat it as a main product and allocate the entire cost to the main products and byproducts on the basis of their relative sales value. Clear? So this is all about how to allocate the cost to the joint products and byproducts. Next one is techniques for measurement of cost. It is nothing but cost formula. If the inventory is not ordinarily interchangeable, means what, sir? They are unique, customized. In that case, follow the specific identification method. Means what? Cost specific to that particular inventory can be considered. Okay. And next one is inventory ordinarily interchangeable. It means what? Inventory can be replaced. In first case, inventory cannot be replaced. They are unique. They are customized. They are unique. In this case, inventories can be replaced. Historical cost method we can follow. Historical cost means actual cost. Okay. Non-historical cost method is estimation based methods, I can say. Estimation based methods we can follow only when it results into approximation to the actual cost. Okay. In that case we can follow. Otherwise we should not follow. As for historical cost method, FIFO and weighted average methods we can follow. FIFO means what, sir? So whatever the inventory we produced, are we purchased first, or selling or issued to the next further process first, and remaining inventory any in our godown is most recently purchased or most recently produced material, right? And as per weighted average cost formula, what we do is you take the total cost in the numerator and take the total quantity in the denominator. You will get the per unit cost. So that is the cost per unit at which we can measure our quantity of inventory, right? And coming to the standard cost method, this is a non-historical cost method. It is of course a costing concept. What we do, we determine a predetermined rate called standard rate. When we know the actual cost, we do the variance analysis. That's it. And in case of retail price method, we can call it as a adjusted selling price method also. In this case, what we do is we deduct the gross margin percentage from the sales value. That gross margin should be determined on the basis of the judgment. Okay, and the resultant amount is the cost at which we can measure our inventory. Usually this method is applicable in retail inventory for fast moving inventories. Okay, so this cost formula, the same cost formula shall be applied to the all inventories having similar nature and similar usage. If the inventories are having a different nature and a different usage, in that case we can follow the different cost formula, but we should justify it. Clear? For example, if we are having one segment in Hyderabad and another segment in Bangalore. In Hyderabad segment, we are trading cement bags. In Bangalore segment, we are in construction industry. Here we just purchase the cement bags and sell to the customer. There we purchase the cement bags, we consume that cement bags in our construction projects. Okay, it means what, sir? Nature is same, cement bags, but usage is different. In this case, we can follow the FIFO cost formula in Hyderabad or weighted average cost formula in Bangalore. It means what? Different cost formula can be followed for Hyderabad and Bangalore segments. Okay, same cost formula also you can follow. It is your choice. Real. And one more. In both segments, our business is only for trading. It is nothing but what's our same nature and same usage. In that case, we should follow the same cost formula, right? So till now, what we have discussed is about determination of cost. Now coming to the next step, that is net realizable value. Net realizable value of finished goods. What we need to take? Firstly, we need to estimate the selling price of finished goods. From that, reduce the selling cost. We will get to know the net realizable value. If it is a work in progress, we may or may not has a market for our work in progress. In that case, same sir. Estimate the selling price of finished goods. From that, reduce the estimated cost to convert the work in progress into finished goods. From that, reduce the selling cost. We will get to know the net realizable value. Net realizable value is our entity specific value. Correct? It is our internal purpose only we are calculating it. Fair value is market related. So fair value less cost to sell and the net realizable value may or may not equal. Clear? And while estimating the net realizable value, we should consider most reliable evidence available at the date of estimation. For suppose, if we have already entered into a contract, if we have already entered into a contract in respect of our inventory, in that case, our contract price, replace the contract price in place of estimated selling price. Okay. If our material is not covered by a contract, in that case, estimate according to, general conditions. Clear? That is what the standard is saying. And one more thing, while estimating the selling price, any event occurred after the reporting period, any event occurred after the reporting period should also be considered. If that event having any condition at the reporting date, at the end of the reporting date, what I'm saying, while estimating the net realizable value, any event that occurred after the reporting period can also be considered if that event is having evidence on the on the end of reporting period. That is what the standard is saying. Example, if our price and demand for our products start declining from 10th March and we sold that inventory on 14th April, let's assume. It means what, sir? Our price and demand of our products start declining before end of reporting period only. So in that case, we can consider that events, right? If our price and demand for the product start declining after the end of reporting period, in that case, we need not consider that. That is what the standard is saying, right? So till now, what we have discussed? We discussed cost and we discussed net realizable value. Next step is we need to compare. How to compare? Standard is saying that compare the cost and net realizable value for item by item, and you can compare for group of similar inventories also. But standard is saying that don't compare inventory wise like finished goods for work in progress for raw material. You should not compare like that. Okay. And also inventories in a particular operating segment. For suppose we are having a segment in Hyderabad, second segment in Bangalore. We should not treat all inventories in Hyderabad segment are having a group of similar inventories. That is what the standard is saying. Okay, what I'm saying, we need to identify, we need to compare the cost and NRV item by item or group of similar inventories. Okay, we should not compare finished goods to finished goods, raw material to raw material, work in progress to work in progress, or we should not assume inventories located in one segment are having a group of similar items, right? So that is what the standard is saying. After comparison, if for suppose if our NRV is lower than cost, we should measure our inventories to NRV. So whatever the difference between cost and NRV, you charge to profit and loss account, right? That is what the standard is saying. And if we use our raw material in manufacturing of finished goods, okay, if we use our raw material to manufacture finished goods, if that finished goods is sold at or above cost, in that case raw material can be measured at cost only, even though that raw material NRV is lower than cost of raw material. If finished goods in which our raw material is incorporated is selling not at or above cost, in that case raw material should be measured at replacement cost. That is best NRV, right? And next one is a reversal of write down. So whatever the inventories we have write down to NRV should be reassessed for each subsequent period. On such reassessment, if we notice that conditions that led to write down in the previous year no longer exist or our NRV increased, in that case we should reverse. We should reverse that. And that reversal should be that reversal should not exceed our previous write down. That is what the standard is saying. Clear what I am saying? Our reversal should not exceed previous write down. And after such reversal, our carrying amount of inventory should be cost or NRV, whichever is lower. What the standard is saying. And next one is, if we sell that inventory, we should de-recognize it. See here, we are crediting inventory and debit will go to cost of goods sold. No, if we are not selling, we are using that inventory in our construction project, construction of PPE. In that case, you capitalize to PPE. PPE account debit to inventory accounts. That's it, sir. This is all about Ind AS 2. To quickly revise Ind AS 16, property, plant and equipment, right? Let's start. Firstly, what is property, plant and equipment? Ind AS 16 specifically defined it as tangible assets only. It means what? Intangible assets are not covered by this standard. They are covered by a separate standard, and that is Ind AS 38. These tangible assets held by the entity for usage only. For what purpose? For production of goods, or for providing services, or for administration functions, or that asset can be given on a rental basis also. But note that asset is expected to be used for more than one accounting period, then only that asset is said to be a property, plant and equipment as per Ind AS 16. At this stage, I would give you one clarity. If land or building or both are given on a rental basis, in that case, Ind AS 40 investment property is applicable. Ind AS 16 is not applicable in that case, right? And coming to the scope of this standard is not applicable to PPA held for sale and biological assets and exploration evaluation assets and mineral rights and reserves. But note that burial plants, despite of their biological assets, are covered by Ind AS 16 only. Clear? And one more thing, if any property, plant and equipment that is used to develop or maintain these assets, that PPA is also covered by Ind AS 16. Clear? And coming to the definition of burial plant, as we discussed, burial plants are covered by Ind AS 16, despite of the fact they are biological assets, correct? So what are burial plants? They are living plants only, like mango tree, coconut tree, apple tree. They are used for production or supply of agricultural produce, and they are expected to produce for more than one accounting period, and they have a remote chances of being sold as an agricultural produce except as an incidental scrap sale. So as we discussed, apple tree, mango tree, coconut tree satisfy this definition, so we can account them as burial plants as per Ind AS 16. If you correlate the same with the short-term crops like paddy, corn, or other short-term crops, they don't satisfy this definition, because second condition and in some circumstances, third condition, they can't satisfy. Hence, they are scoped out of Ind AS 16. We can check Ind AS 41, right? And any plants that are grown for wood purpose, timber purpose also scoped out of Ind AS 16, because they can't satisfy the burial plant definition, right? So till now, what we have discussed is definition of property, plant, and equipment, bearer plans, and scope of the standard. The next step is once an asset satisfies the definition of PPE, subjected to scope of the standard, if that asset satisfies the recognition criteria, we can recognize that asset as property, plant, and equipment by passing this journal entry. What is that? PPE account debit to bank or vendor account, as the case may be. So, what is the recognition criteria? It is probable that means what more likely to happen. I can say more than 50% chances that cash flows, economic benefits arising from that particular asset should flow to the entity, or cost of that asset can be measured reliably. If these two conditions are satisfied, we can say that that asset is satisfying the recognition criteria. Thereby, we can recognize that asset as property, plant, and equipment. Right? So, what is the economic benefits? Economic benefits means because of we are acquiring that asset, our revenue is increasing or our cost is reducing or simultaneously both can happen, which ultimately leads to increase in cash and cash equivalents. So that is economic benefits. Sometimes major spare parts and standby equipments like electric generators and servicing equipment can also satisfy the definition of PPE. In that case, we can recognize as property, plant, and equipment. Otherwise, we can classify them as inventory. That is what the standard is saying, right? And small items like tools, dies, molds, they are individually insignificant. In that case, what the standard is saying that instead of applying the recognition criteria to that individual items, aggregate them and apply the recognition criteria to the aggregated value. That is sufficient. That is what the standard is saying, right? And some assets, because of their acquisition, we won't get any economic benefits. However, their installation or their presence is very essential for the entity to get the economic benefits from other assets. So such kind of assets also eligible for recognition as property, plant, and equipment. The best example for them is pollution control equipment and safety equipment. Right? These equipment don't generate any economic benefits, correct? However, their installation may become mandatory by government rules or laws, correct? So these are the good examples for that kind of assets. So till now, what we have discussed is about only to the extent of passing this journal entry, correct? But at what amount this journal entry should be passed, we have not discussed. So that is going to be our next discussion. Right? Standard is saying that once an asset satisfies the definition and the recognition criteria, we can recognize that asset initially at cost only, at cost, no other amount. How to determine that cost is completely depends upon mode of acquisition of that asset. Mode of acquisition means what? How we acquired that asset. Whether we acquired that asset by exchanging our own asset or whether we acquired a ready-made asset that is available in the market or whether we are self-constructing our own asset. Okay, let's discuss the cost determination for each case. Firstly, cost of an acquired asset means what? There is a ready-made asset available in the market. We are approaching to acquire that either cash or credit basis, right? So what are all the costs included for capitalization and what are all the costs should not include for capitalization? That is our discussion, right? Purchase price included, non-refundable taxes and duties included. If they are refundable in nature, we should not include. Like if GST input tax credit is blocked or ineligible, that is non-refundable in nature, we can capitalize it. If it is eligible credit and the entity is going to avail it, it is refundable in nature, that credit we should not capitalize. And trade discounts we can reduce, however, cash discounts should not reduce. Next one, directly attributable cost. Directly attributable cost means what? These are the costs incurred to get the asset to the intended location and condition. Without incurring that cost, it is highly impossible for us to get our asset to the intended location and condition. Standard has given few examples. Let's discuss one by one. Employee benefit cost means what? Wages and salaries that are directly related to acquisition or construction of PPE, we can capitalize. Cost of site preparation. In order to install our machinery, we need to prepare the site. So whatever the cost we incur on that, we can capitalize it. Initial delivery and handling cost means what? Loading, unloading charges, freight charges, transit insurance. This and all we can capitalize it. Installation and assembly cost. Without installation and without assembly, how can we say that our asset is in the intended location and condition? Correct. So whatever the cost we incurred for that installation and assembly, we can capitalize it. Professional fees. Sometimes we may need consultation of engineers or any other experts. So whatever the fees we pay to them can be eligible for capitalization. Cost of testing. I can say trial run expenses can also eligible for capitalization. Let's assume we have acquired this machine. Now we are testing this. In order to test this, we have given some inputs to this machine by way of raw material, let's assume. So whatever the cost we incurred to acquire this raw material, we can capitalize it. If we get any output from this machine, if that output is having a market, if we sell this output in the market, we can get some sale proceeds, correct? So this net cost can be eligible for capitalization. Even this amount is negative. Even this amount is negative, we should adjust it to the cost of PPE only. We should not recognize that amount in profit and loss account. So that is what the standard is saying. And standard has given few examples that are not directly attributable costs. What they are? Cost of conducting business. I can say operating expenses. Operating expenses should not be capitalized, recognizing profit and loss account as an expense, which includes cost of staff training. Staff training cost also should not be capitalized. Cost incurred in introducing new product and service, nothing but advertisement expenses and promotion expenses. So that one also should not be capitalized. Cost of opening a new facility, administration expenses, other general overhead costs also charged to profit and loss account should not be capitalized, correct? If our asset is financed by a loan, obviously we incur interest cost, correct? So if that interest cost is eligible for capitalization as per Ind AS 23 borrowing cost, we can capitalize it. Otherwise, we should not capitalize it. And next one is restoration cost and dismantling cost. This is our future cost, correct? For suppose if we are installing our machinery on land, that is having a 5 years useful life, let's assume. It means what? At the end of fifth year, we need to dismantle that machine and restore the land to its original condition. Right? So in order to do that, we need to incur some cost at the end of fifth year. So what the standard is saying that calculate the present value of that cost to today and capitalize that amount to property, plant and equipment. That is what the standard is saying. And as usual, sir, we need to create a provision for decommissioning liability as per Ind AS 37. We need to recognize the interest cost on that at the end of each year till end of the fifth year. Right? We can say that it can be called as an unwinding of discount. See here, decommissioning liability is recognized at present value of future cost, and the same is added to PPE. So what is the journal entry, sir? PPE account debit to provision for decommissioning liability. At what amount? Present value of future cost to dismantle that machine and to restore that land to its original condition, right? There is an unwinding of discount each year and that provision. That is what the standard is saying. If we acquire any PPE beyond normal credit terms, means what, sir? Abnormal credit period. So whatever the consideration we are going to pay to the vendor includes interest cost, right? So what the standard is saying that interest cost charge it to profit and loss account as an expense that should not be capitalized unless it is allowed by Ind AS 23 borrowing cost. And in that case, our property, plant and equipment shall be initially recognized at cash price. Cash price means what? Transaction price. It means if we would have paid that amount today, at what amount we need to pay to that vendor. So that is cash price. In case cash price is not available, recognize that asset at present value of future payments. That's it, sir. It is what standard is saying. This is the summary of what we have discussed in case of a ready-made asset available in the market, right? And next one is cost of self-constructed asset. We can see this as a capital work in progress or CWIP or asset under construction, GL in the company's books of accounts. So whatever the principles we have discussed in case of a ready-made asset that is available in the market are equally applied here also. Okay. Here we need to capitalize all actual costs, be it is a material cost or labor cost or any other overheads. If they are directly related to our construction activity, then only we should capitalize it. Otherwise, we should not capitalize. Any notional profits, any internal profits should not be capitalized. Okay, they should be eliminated. They should be ignored. For suppose we are in business of manufacturing cement and we sell that cement bag in the market for 400 rupees, our cost of manufacturing is 300 rupees. And we are constructing a building. So in order to construct building, why should we buy the cement bags outside? Because we are only in the manufacturing of cement, correct? So we are using that 1000 cement bags, let's assume. In this case, 1000 into 300 or 1000 into 400, which amount should be capitalized? Standard is saying that 1000 into 300 only we should capitalize, right? That represent actual cost. If we include 1000 into 400, it means what, sir? Internal profits also we are capitalizing. But what the standard is saying, internal profits should be eliminated, right? And next one is any abnormal loss, be it a material cost or labor cost or any other resources, we should not capitalize it. And any income or expense from incidental operations should be charged to, should be recognized to profit and loss account, that we should not adjust it to the cost of PPE. Let's say, for example, we are constructing building here, and this vacant land we are giving for a parking lot. So from that parking unit, we are getting parking charges as our income. And we deployed a security personnel to protect the vehicles. For that security personnel, we are paying the salary. That is our expense. So whatever the income, whatever the expense arising from this unit should be recognized in profit and loss account. We should not adjust it to our building cost. That is what the standard is saying. Because these operations are not necessary to bring our building to the intended condition and location. Correct? And one more thing. If we, you know what? While constructing the building, generally scrap generates, correct? So if we sell that scrap in the market, whatever the sale proceeds we get, so that sale proceeds we can reduce from the cost of PPE. That is what the standard is saying, right? And next one, cessation of capitalization. When we should stop capitalizing the cost. So once an asset is in the intended location and condition, once an asset is in the intended location and condition, any further cost incurred should not be capitalized. That cost we should charge to profit and loss account. Clear? That is what the standard is saying. These are the examples. See here, initial operating losses. Today only we inaugurated our factory, let's assume. Initially, we are going to incur operating losses, correct? So that operating losses we should not capitalize. We should charge to profit and loss account. Cost of relocation or reorganizing part or any of the operation, that also we should not capitalize. And this one we have already discussed. Any further cost incurred after our machine or our PPE is in the intended location and condition, that cost should not be capitalized. That cost should be charged to profit and loss account, right? So whatever the principles we have discussed till now is applicable to bearer plants also, because we discussed that bearer plants are also covered under Ind AS 16, despite of the fact that they are biological asset. In this case, what are all the costs we can capitalize? I can say cost of sapling, okay, and labor cost for the plantation, and fertilizer cost, pesticides cost, water charges. So these are all we can capitalize it till the sapling comes to a stage of tree, right? So I can say that much only, right? Now next one is measurement of assets acquired in exchange transaction. It means what, sir? Let's assume property, plant and equipment A. This is the asset we are acquiring. Property, plant and B. This is an asset we are giving away. So what we do generally, firstly we need to de-recognize our asset, correct? To PPE B. At what amount, sir? Carrying amount, we should de-recognize it. And next one is PPE A account. This is we are acquiring. So at what amount this asset should be recognized? That is our discussion, correct? So in order to check that, firstly we need to check whether a commercial substance exists, whether commercial substance exists in that exchange transaction or not, and fair value of either asset given up or fair value of asset that we are acquiring can be measured reliably or not. What I am saying, in order to recognize the asset that we are acquiring, firstly we need to check whether commercial substance exists in that exchange transaction or not, or fair value of either asset given up or fair value of asset that we are acquiring can be measured reliably or not. If these two conditions are satisfied, we can recognize the asset that we are acquiring at fair value. So this amount this amount at fair value. Fair value of which asset? Fair value of asset acquiring or fair value of asset that we are given up. Standard is saying that fair value of asset that we are given up is the first preference. Fair value of asset that we are acquiring is the second preference. Here one clarification. If fair value of asset that we are acquiring is more clearly evident than fair value of asset that we are given up, in that case, we can recognize the asset that we are acquiring at its own fair value only. So that is what the standard is saying, right? So what is the commercial substance? Because accounting in exchange transaction is completely depends upon commercial substance, correct? What is the meaning of commercial substance? In order to check existence of commercial substance, firstly we need to check the configuration of cash flows of both assets. Configuration of cash flows means what? Risk, timing, nature and amount of cash flows of asset that we are acquiring and asset we are given up should be different. For suppose, I am given up my building and acquiring your jet. It means what, sir? Risk of cash flows, timing of cash flows, nature of cash flows are all different, correct? I can say commercial substance exists. Next case, for suppose, I am given up my office building to you and I am acquiring your office building. Here, same configuration of cash flows are same, right? There is no commercial substance. In another way, we can say we can calculate the entity specific value of both assets. If the entity specific value is significantly different, in that case, we can say commercial substance exists. Entity specific value means what, sir? It is nothing but post tax post-tax present value of cash flows that assets generate. So in terms of configuration of cash flows and entity specific value, we can check commercial substance, right? If commercial substance exists and fair value of either assets given up or fair value of asset that we are acquiring can be measured reliably, we can recognize the asset at its fair value. At which fair value we discussed. Preference first preference is asset given up. Second preference is asset we are acquiring. In case of fair value of asset we are acquiring is more clearly evident than fair value of asset that we are given up. In that case, fair value of asset that we are acquiring can be taken for recognition of that asset we are acquiring, right? So that is what the standard is saying. Now, what is the accounting treatment? If the cash is not involved, just we are exchanging the asset. In that case, as usual, sir, we recognize our asset its carrying amount, recognize the asset at fair value. That preferences we have already discussed. In case of cash involved, and one more thing, here any difference is there, be it gain or loss, you recognize in profit and loss account. And the second case, if cash involved, we are acquiring their asset by exchanging cash along with our asset. In that case, see here, this is we are de-recognizing at carrying amount. This one we are recognizing at fair value. If we are making the payment, credit the cash or bank. If we are receiving the payment, debit the cash or bank. The difference between debits and credits, you can recognize them as gain or loss in profit and loss account. That is what the standard is saying. And second, and the next situation is, for suppose commercial substance not exist or fair value of either of the assets cannot be measured reliably, or both commercial substance not exist and fair value cannot measure reliably. In that case, accounting treatment should be done in such a way that no gain or no loss should be recognized. See here, when there is no cash is involved, what we are doing, asset we are given up is recognizing at its carrying amount, correct? Asset that we are acquiring shall also be recognized at carrying amount of asset that we are given up. What I am saying, asset that we are acquiring shall also be recognized at carrying amount of asset that we are given up. So here no gain or no loss that we already discussed. This transaction should be recognized in such a way that no gain or no loss should be recognized. Clear? And next, when cash is involved, as usual, sir, you de-recognize it its carrying amount. If you are making the payment, credit it. If you are getting the amount, you debit it. This will become our balancing figure because no gain, no loss should be recognized. Right? No gain, no loss. So this is all about cost determination in case of asset that we are acquiring by way of exchange or self construction asset or asset that is ready made in condition. So with this, what can I say is PPE account debit to bank or vendor account. So till now we have discussed, correct? Till now we have discussed about only for initial recognition. Beyond that, we have not discussed anything, correct? For suppose, if we incur any cost that is subsequent to the initial recognition, that cost also eligible for capitalization only if it results into getting an additional future economic benefits. Otherwise, charged to profit and loss account. And replacement of parts of PPE, we can call it as component accounting. In this case, what the standard is saying that an asset, for suppose an asset is having a machine is having a different engines installed therein, right? And each engine is having a different useful life. So in that case, we cannot take one useful life to depreciate that asset, correct? So what the standard is saying that in that situations, do the component accounting. Account each engine separately. So in that process, if we replace any engine with a new engine, in that case, new engine can be capitalized if it satisfies the recognition criteria. And existing engine, we should de-recognize it at its carrying amount. That is what the standard is saying. That's it, sir. Nothing more. And major inspection and overhaul. Some machines, some assets requires a major inspections or overhauls for a specific after a specific period of time. Right. So what we need to do is this major inspection or major overhaul. We should consider it as one of the component of that asset, and we do the component accounting. Same to component accounting, sir. Only one thing is we need to assume that major inspection or overhaul as a component. For suppose after some period of time, we need to go for a major inspection. So whatever the inspection costs we are going to incur, that we can capitalize if that meets the recognition criteria. And whatever the carrying amount of previous inspection, so from that we are not going to get any future economic benefits. So we need to de-recognize that at its carrying amount. That is what the standard is saying. That's it. And next one is subsequent measurement. After initial recognition, at what amount we need to carry our asset, we need to carry our PPE at the end of next reporting periods. That is our discussion. Standard is saying that you can follow cost model or you can follow the revaluation model for subsequent measurement. Whichever the model, be it cost model or revaluation model, that becomes your accounting policy, and that accounting policy should be consistently applied for entire class of PPE. Class of PPE means what? Assets are having similar nature and similar usage. It means what? If the assets are having similar nature and similar usage, we should follow only either cost model or a revaluation model. If the assets are having different nature and different usage, in that case, we can apply different accounting policy, right? Accounting policy means what, sir? That is cost model or revaluation model. For suppose we are applying the revaluation model for the first time. Previously, we have applied cost model. In that case, what Ind AS 8 is saying that retrospective accounting is not required. Apply the revaluation accounting prospectively, that is sufficient. So that is what the standard is saying. Now, how to calculate the amount at which we can carry the asset at the next subsequent reporting periods. If it is a cost model, it is simple. You write the cost that we determined initially. From that, reduce the accumulated depreciation, and from that, reduce the accumulated impairment loss, if any. The resultant amount is the amount at which we can carry our PPM. And if it is a revaluation model, you take the fair value at the date of revaluation. From that, reduce the accumulated depreciation subsequent to the date of revaluation. Don't reduce the accumulated depreciation that is prior to the date of revaluation, right? And the same with impairment loss, that resultant amount will become our amount at which we can carry our PPE. Just because following revaluation model doesn't mean we should revalue our asset for each year. What the standard is saying that is completely depends upon fair value fluctuations. If the fair value fluctuations of our PPE are significant and volatile, annual revaluation, you go for annual revaluation. If the fair value fluctuations are not significant or not volatile, in that case, once in 5 years or once in 3 years is sufficient. So this is the step one. In step one, we decide whether it is annual revaluation or once in 3 years or once in 5 years, correct? So in step two, what we do, we are going to execute the decision of step one, be it annual revaluation or once in 3 years or once in 5 years. So in this step two, what we do is, what the objective of the standard is, carrying amount of PPE does not materially differ from fair value. It means what? As per step one, means what? As per our decision to revalue annually or once in 3 years or once in 5 years. In step two, we are going to execute that. While revaluing our asset, we find that fair value of that asset is not materially different from the carrying amount. In that case, revaluation is not necessary. If the fair value of that asset is materially different from carrying amount of the asset, in that case, go for revaluation. So that is what the standard is saying, right? And next one is revaluation, accounting treatment for revaluation. If it is a first time revaluation, recognize the revaluation gain in OCI that is going to be accumulated in equity section under the heading revaluation surplus. If it is a revaluation loss, charge that loss to profit and loss account, profit or loss account. So that is what the standard is saying. If it is a subsequent revaluation, okay, in the earlier revaluation it is a gain and now it is also gain. In that case, also you recognize the gain in OCI. It will accumulate in equity under the head revaluation surplus. Prior also loss, now also loss, you debit to PRL. Previously it is a gain, now it is a loss. So what the standard is saying, that recognize this loss in OCI to the extent of balance available, and remaining loss, if any, that you recognize in PRL. Previously it was a loss, now it is a gain. So what the standard is saying, that recognize this gain in PRL to the extent of previous loss, and remaining gain, if any, you can recognize in OCI section. So that is what the standard is saying. And one more thing is, if we get the revaluation surplus, in that case, what happens? We need to charge the additional depreciation, correct? We need to charge additional depreciation. So standard has given two choices, two alternatives. What is, to the extent of that additional depreciation, make a transfer entry. What is that? Transfer an amount to the extent of additional depreciation from revaluation surplus to the retained earnings. So this is one alternative. Another alternative is, you do nothing. You don't do anything every year. At the end of what I can say, at the time of disposal of PPE or derecognizing the PPE, you do one thing. Whatever the balance available in revaluation surplus that is directly related to that particular asset, make a transfer that amount from revaluation surplus to the retained earnings. So this is what the standard is saying, right? And next one is, if the entity follows accumulated depreciation method, how to deal with the revaluation. Standard has given two alternative treatments for accumulated depreciation at the date of revaluation. What they are? Depreciation elimination approach and restatement approach. Okay. In case we follow the accumulated depreciation method, one more account come into the picture, right? What is that? Accumulated depreciation account, right? So in case of depreciation elimination approach, what we need to do is, we should eliminate the balance in accumulated depreciation account, that we should adjust to the gross carrying amount of the asset only. If it is a restatement approach, we just calculate the percentage of change, means what? Percentage of that surplus or deficit to the carrying amount. We need to restate our gross carrying amount of the asset and accumulated depreciation to the extent of the percentage we have determined. So let's discuss this with the numbers. Here what our cost is 1 lakh and accumulated depreciation 55,000, means what? Our carrying amount is 45,000. Fair value is 65,000. Okay, let's write here for easy understanding. What is that? 1 lakh 55,000 means what? 45,000. Let's write the place. 1 lakh 55,000, 45,000. This is original cost, this is accumulated depreciation, and this is the carrying amount. Now this is the fair value, correct? So the first step is, we need to calculate the percentage of this change. So how much, sir? It is gain 20,000, correct? Now you calculate the percentage. So this is the percentage. Now what the standard is saying, that It is surplus, correct? Surplus means we need to increase the gross carrying amount of asset for 44.44%. This one also we need to increase by 44.44%. You will get some X here, Y here. This net amount will become 65,000 only, which represents 45,000 carrying amount plus 20,000 gain. So you just see the journal entry, you will get more clarity. Here asset, its original carrying amount, original gross carrying amount is 1 lakh into 44%. We are increasing the asset by this much. You do the same for accumulated depreciation. 55,000 is the accumulated depreciation on the date of revaluation. You increase that also. So this is the balancing figure, correct? This is equals to this much. So that is what's done. Simple, sir. Okay. And next one is a depreciation. Correct. Next concept is depreciation. This we are studying from CA foundation level, correct? So what is depreciation? Depreciation is nothing but what's a systematic allocation of depreciable amount of an asset over its useful life. So that amount we can charge to profit and loss account as an expense. What is the depreciable amount? Original cost. If it is a cost model, original cost minus estimated residual value. If it is a revaluation model, substituted fair value minus estimated residual value, we can get the depreciable amount. So in this formula, that residual value or useful life, both are estimations, correct? So what the standard is saying that review that estimations at the end of each financial year. If any changes we notice, account them as change in accounting estimate as per Ind AS 8. So that is what the standard is saying. Depreciation of the asset begins only when the asset is available for usage, not when the asset is put to usage. For suppose, my building construction completed today, but I don't have any auspicious days for the next 6 months. I have auspicious days only after 6 months. Do Ind AS 16 allows to not to charge the depreciation for next 6 months? No. Auspicious days, not auspicious days, that is your personal affair, sir. I don't care about your personal things. So we need to charge the depreciation from today onwards because your building is available for usage, right? That is what the standard is saying. And coming to the method of depreciation, the standard is not rigid about a method of depreciation. So it is saying that the method of depreciation should reflect the pattern of consumption of economic benefits of that particular asset. If the pattern of consumption of economic benefits are uniform, follow the straight line method. If the decrease, follow written down value method. If that are directly linked to your units of production or hours or days, you follow the depreciation method accordingly. So that is what the standard is saying. And at the end of each year, we need to review our depreciation method also. If there is any change in pattern of consumption of economic benefits, we should change our method of depreciation also to reflect that pattern. So that change is also accounted as change in accounting estimate as per Ind AS 8, right? And depreciation of the asset ceases at the earlier of the following dates. When that asset is classified as held for sale or included in the disposal group that is classified as held for sale, or asset is de-recognized. So in if earlier of these 2 days, depreciation is ceased. And next one is depreciation of the asset can be zero when we follow the units of production method and for any particular year there is no production. Our residual value is greater than or equal to carrying amount. So it's right practical residual value. If the residual value is greater than or equal to carrying amount, obviously there will be no depreciation, right? And when we should de-recognize the property, plant, and equipment, carrying amount of the PP should be de-recognized when on disposal are no more economic benefits expected from that particular PPA. So the resultant difference between the journal entry we can recognize in profit and loss account as a gain or loss. What is the journal entry, sir? Credit to property, plant, and equipment at carrying amount because we are de-recognizing. Debit. If you are able to sell that in the market, if you are able to get the sale proceed, debit with bank account. That difference you can make it to profit and loss account. And that's what I'm saying. And next one is accounting for decommissioning liabilities. What we discussed is we are going to incur a future cost to dismantle the machine and restore the land to our original condition. We can say it is a dismantling cost and a restoration cost. That is our future cost, correct? So at the initial recognition, we capitalized that amount at present value of future cost, PPE account debit to provision for decommissioning liability account. For PPE, we capitalized, and for that portion, we are going to charge depreciation for subsequent years. That story is ended. Now we are discussing about a credit part. What is that provision for decommissioning liability? At the end of each year, we need to recognize the interest on that provision for decommissioning liability. See here, interest account debit to provision for decommissioning liability. For suppose if for any reason, any year, we re-estimated that our future cost to dismantle that machine and restore that land to its original condition, either increase or a decrease when compared to our original estimation. So how to do the accounting in that situation is our discussion. So what the standard is saying that accounting is completely depends upon whether you are subsequently measuring your asset as per cost model or a revaluation model. If it is a cost model, be it an increase in future cost or reduction in future cost, we should adjust it to the PPE only. If it is a increase in future cost means what? Our liability is increasing. So increase the liability by crediting to provision for decommissioning liability. And corresponding debit you give to property, plant and equipment only. If it is a reduction of liability, so do the reversal, sir. Debit the provision and credit the property, plant and equipment. So that's it. If it is a revaluation model, we are subsequently measuring our asset as per revaluation model, how to deal with it. You just treat it as a revaluation surplus or revaluation deficit. That's it, sir. But suppose if our liability is increasing, assume it is a revaluation loss, do the accounting as a revaluation loss only. For suppose if the earlier revaluation gain is there, recognize that revaluation loss in the revaluation surplus to the extent of balance available and remaining you recognize in profit and loss account. As usual, our liability is increasing, so you credit to provision for decommissioning liability. For suppose our liability is decreasing, assume it as a revaluation gain. So first you recognize that gain in profit or loss to the extent of earlier loss, see here, and the remaining balance you recognize in revaluation surplus, means OCI part. And as usual, liability is decreasing, you decrease the provision by debiting it. That's it, sir. Let's start. As we know, the standard is applicable to accounting for borrowing costs. However, there are some exceptions. What they are? The standard is not applicable to cost of equity, including cost of preference share capital that is not classified as liability. It means what? That is also an equity instrument, and cost of that equity instrument is also scoped out of the standard. Similarly, we should not apply the standard to the assets that measured at fair value, because fair value means what? It is a market based number that considers everything including borrowing cost. So we should not apply this standard to the assets measured at fair value. Similarly, inventories that produced in large quantities on repetitive basis and frequent basis are also scoped out of this standard. Clear? And come to the core principle of this standard, borrowing costs that are directly attributable to acquisition of qualifying asset or construction of qualifying asset or production of qualifying asset must be capitalized. It means what? Such borrowing costs should be added to cost of qualifying asset instead of charged to profit and loss account as an expense. And any other borrowing cost we can recognize as an expense in profit and loss account. In order to conclude whether borrowing costs can be capitalized or not, firstly we need to know what is borrowing cost and what is qualifying asset, correct? So let's discuss one by one. Firstly, borrowing cost means what? These are interest cost, basic interest amount, coupon amount, and other costs like transaction charges, processing fees that are incurred in direct connection with borrowing of funds, and also include interest expense that we calculate in amortized cost method by applying effective interest rate. You recollect your Ind AS 109 knowledge. As for amortized cost method, what we do? We recognize interest expenses at the end of each reporting period by applying effective interest rate, correct? So that interest expenses can also be part of borrowing cost. Similarly, as per Ind AS 116 leases, we recognize ROU asset account debit to lease liabilities account, correct? At the end of each reporting period, or as per the lease agreement terms, we recognize interest on lease liabilities, correct? So that interest is also forming part of borrowing cost. And next one, this is important for your exams. If we get any foreign currency loan, definitely we expose to foreign exchange risk. because foreign exchange rates fluctuates frequently. Correct? If we incur gain in the year of borrowing, it is easy for us. As per Ind AS 21, we can recognize that gain in profit and loss account. However, if it is a exchange loss, that exchange loss can also be part of borrowing cost, but not 100%, only to the extent of adjustment to an interest cost. How to calculate that amount? Simply, we need to follow these 6 steps. If we follow these 6 steps, we can get out of the confusion. We can easily calculate that amount. Firstly, you calculate actual interest on your foreign currency loan. How to calculate actual interest? You take that amount, multiply that with foreign interest rate, and you translate that foreign currency to our functional currency by using closing rate. Actually, we should take average rate, that is appropriate. But in our ICS study material questions or RTP questions, average rate is not available. They are giving closing rate only. Okay. So here I am also taking closing rate. You calculate actual interest on your foreign currency loan. That is first step. And in second step, you calculate the notional interest. It means what? If we would have taken a loan from a bank in India, how much interest cost would be? So that you calculate. Simply, you take that dollar, that foreign currency loan, multiply that with spot rate on the date of taking the loan, apply the interest rate. You will get the notional amount of interest. And in third step, you calculate the difference between step 2 and step 1. It means what, sir? It is nothing but interest saving. In step 1, we are calculating interest on foreign currency loan. Generally, foreign currency loans offers lower interest, correct? However, our functional currency loans offers at a high rate of interest. So difference between step 2 and step 1, we can treat it as a interest saving only. In step 4, simply you calculate foreign exchange loss. If it is a gain, we need not perform all this. We can directly recognize that gain in profit and loss account because we are in first year of taking loan. And in the step 4, once you calculate the foreign exchange loss, simply you compare the two amounts, amount in step 3 and amount in step 4. What does it mean? You are comparing interest saving amount and foreign exchange loss. So that lower of these two amounts can be your deemed borrowing cost. Lower of that two amounts can be deemed borrowing cost that you can capitalize to cost of qualifying asset. So total amount of borrowing cost, how much we can capitalize? Amount in step 1 because that is our actual borrowing cost. Amount in step 5 that we calculated. It means what? It is an exchange loss that we are treating as a deemed borrowing cost by applying first 5 steps. Simple, no confusion, right? For suppose we are coming to second year of taking loan. So in that year, how to deal? Let me write like this. This is first year. This is second year. Situation 1. First year gain. Simply you recognize in P&L account. Second year also gain. Same. Do the same. Second year there is a gain. Simply you do recognize in P&L account. In second year there is a loss. You apply the 5 steps. You will get to know how much amount of foreign exchange loss can be capitalized. In step number 3, first year there is a loss. Same, you perform 5 steps. Second year also loss. Do the same. 5 steps. This fourth one is a little tricky one. This confused the students, correct? What is that? In first year there is a loss. As usual, perform 5 steps. You will get to know the exchange loss that can be a deemed borrowing cost. In second year, there is a gain. So how to deal with this situation? That is our discussion now. Okay. Let's assume in the first year, our foreign currency loss, foreign exchange loss is rupees 1 lakh. Our foreign exchange loss is rupees 1 lakh. This is our step number 4. In step number 3, our interest saving is rupees 80,000. Let's assume this is an example only. Don't take serious about numbers. Go with concept. So in step 5, what we need to do? Step 3 or step 4, whichever is lower. That is the deemed borrowing cost, correct? In this example, 80,000 is our deemed borrowing cost. This we capitalized in year 1. This we capitalized in year 1. For suppose in year 2, we are not incurring any foreign exchange loss. We are getting a gain. Let's assume situation 1. Our gain amount is 1 lakh rupees. Situation 2. Our gain amount is 60,000 rupees. Okay. In these two situations, how to deal? This is second year. Second year, I am making two situations. This is situation 1, this is situation 2. How to deal with in second year with gain, okay? So simply you compare this 1 lakh with this deemed borrowing cost, 80,000. Here also, 80,000. This is deemed borrowing cost. This is current year gain, okay? This is the deemed borrowing cost that we capitalized in first financial year. This is our gain in current financial year. Now what standard is saying that lower of these two amounts, you take the lower of these two amounts. Here how much it is? 80,000. Here how much? 60,000. Now what to do with this lower of amounts? This lower amount you reverse. Reversal means what, sir? In previous financial year, there is a loss. That loss we capitalized to cost of qualifying asset. Now it is gain. In current financial year, we are gaining. So you reduce this amount. You reduce this amount from cost of qualifying asset. Here also same. You reduce that. That's it, sir. No more confusion. Clear? And next one. Qualifying asset. What is qualifying asset? Standard defined that it is an asset that takes necessary time, substantial period of time. What I mean, this is an asset that necessarily takes substantial period of time to get ready for its intended use or sale. Sir, if it is intended use is fine. That is going to be our asset we are going to use. What is this sale? Sale means it is an inventory. If inventory takes substantial period of time to get ready for its intended sale, that can also be a qualifying asset. If we incur any borrowing cost in connection with that inventory, we can capitalize it. Sir, at the starting of this session, you said that inventories that produced in large quantities on repetitive basis are scoped out of the standard. Now you are saying that inventories are also qualifying asset. In our initial discussion, that inventories are produced in large quantities on frequent basis. However, in this case, the definition is clearly saying that even inventory also takes substantial period of time. If inventory that necessarily takes substantial period of time, you can treat it as a qualifying asset. You can capitalize the borrowing cost, if any, that incurred in connection with that. Sir, what is substantial period of time? Is it 12 months or 6 months or 18 months or 2 years? Standard has not provided any guidance about it. It is completely based on judgment, subjected to facts and circumstances of each case. Even I can't tell you 12 months is a substantial period of time or 18 months is substantial period of time because it is a judgment based. We should consider facts and circumstances of each case. For suppose, if your exam question comes like this, on first day of the financial year, construction started, 31st December of the same financial year, construction ended. It means what? In 9 months, construction completed. So in that case, we should consider the facts and circumstances of that question. Based on our judgment, we can conclude whether it is substantial period or not. Okay. I cannot even say you confidently. We should take 12 months as a substantial period of time. Clear? And financial assets. What means? Investment in shares, debt securities, trade receivables. These are financial assets, correct? So these financial assets are also scoped, not a qualifying assets. Because they don't take substantial amount of time. They don't take substantial period of time to get ready for its usage or sale. At the moment we invest, that becomes readily available. correct? And also an asset that is ready for intended usage at the time of acquisition are also not qualifying asset. However, we need to consider one thing. If an asset is ready for intended usage in a foreign country, it is very far from our country. If the transportation takes 6 months and installation takes another 3 months, it is taking substantial period of time, correct? So we should consider the facts and circumstances of each case. That is our judgment based, right? And till now, what we have discussed, scope of the standard, core principles, and qualifying asset and borrowing cost, right? Now you see this recognition criteria. It is similar to Ind AS 16 and 38, correct? See this? Borrowing costs that are directly attributable to acquisition, construction, production of qualifying assets shall be capitalized only when these two conditions are satisfied. What they are? It is probable that asset will generate future economic benefits and that qualifying asset cost can be measured reliably. If these two conditions are satisfied, then only we can capitalize that borrowing cost. Otherwise, charge that borrowing cost to profit and loss account as an expense. That is what the standard is saying. Okay, and next one, period of capitalization. When to start the capitalization of borrowing cost? When to stop the borrowing cost capitalization? That is our discussion. Standard is saying that start the capitalization of borrowing cost on commencement date. Commencement date means what? It is a date on which entity start incurring expenses and qualifying asset. Entity start incurring borrowing cost. Entity A undertakes activities that are necessary to prepare qualifying asset for its intended use or sale. So this activity is not only physical construction work, it may be an administration work also, like planning the qualifying asset, planning the construction, designing the qualifying asset, or getting approval from government authorities by making an application. Okay, so these are all also an activities that are necessary to prepare the qualifying asset. For suppose this is the 1st April 2024. 1st April 2024, we have taken a loan. It means what? From this date, we are incurring interest cost. And 1st June, we started incurring cost on qualifying asset. And 1st August, we started activities. For example, we applied to the government authorities for getting permission. So out of all these dates, on which date all three conditions are satisfying? On 1st August. 1st August is the date on which conditions are all satisfying. So this is the commencement date. From this date, you can capitalize borrowing cost. Before this, whatever the interest cost we incurred, that you charge to profit and loss account. That is what the standard is saying. Sir, it is fine. We found the commencement date. Till what time we can capitalize? Or we need to capitalize that borrowing cost forever? No, sir. There is a point. What is that? There are two types of cessation. One is permanent cessation of capitalization and this is temporary suspension. For suppose active development of qualifying asset is suspended. Active development of qualifying asset is suspended. For that extended periods, whatever the interest cost we incur, that we should not capitalize. For suppose COVID-19 came, government imposed 9 months lockdown. During that 9 months, no worker came for construction of qualifying asset. Because of that, our active development of qualifying asset interrupted. So during that period, you can charge that expense to profit and loss account. You should not capitalize. For suppose some guy filed a petition in High Court. High Court stayed construction of our qualifying asset. Judgment takes 6 months time to deliver. So during that 6 months, we are not constructing, correct? Active development of qualifying asset suspended. So we should also suspend the capitalization of interest. We should charge that interest to profit and loss account as an expense instead of capitalization. For suppose labor's force, workforce don't come on Sundays or festival days for the work. That is normal, correct? Because of that, active development of qualifying asset not interrupted. In that case, whatever the cost that is, whatever the interest cost that is related to Sundays or holidays, that should be capitalized. We need not charge to profit and loss account. Okay. Similarly, while construction in progress, for some constructions, during the construction period, for 5 days or 1 week or 15 days or 1 month, we should not do anything. We should leave that site. So during that period, active development of qualifying asset is not suspended. It is normal. It is routine in construction process. So during that process also, we should not suspend the capitalization. Clear? And now come to permanent cessation of capitalization. Permanently, we are going to stop the capitalization. Okay? Permanently, we are going to stop. So when to stop? When substantially all activities necessary to prepare qualifying asset for its intended use or sale are completed. It means what? 100% construction not required. If substantially all activities that are necessary to prepare the qualifying asset for intended use or sale are completed, stop capitalization of borrowing cost. For suppose we constructed a building that is a qualifying asset, let's assume. Construction completed except small minor works, fitting doors, painting windows. They are minor works only, correct? In that case, substantially all activities necessary to prepare that building for intended use, or if I am a real estate dealer for sale, is completed. So during that period, we should completely stop the capitalization of borrowing cost. That is what the standard is saying. For suppose if we complete the construction in parts and each part is capable of being used, in that case also we should cease the capitalization of borrowing costs in connection with that part. Let's assume we are constructing 3 buildings in a business park. Out of these 3 buildings, 1 building construction completed substantially and remaining 2 buildings are in progress. So borrowing cost that is related to this building, we should stop. We should stop the capitalization. That is what the standard is saying. Because this building construction is completed, we can use this building independently from another 2 buildings, correct? So we should stop the capitalization of this building. And next one is, the standard has provided provisions separately for specific borrowings and general borrowings. What is specific borrowing? Specific borrowings they are borrowings that have taken specific to construction or acquisition or production of qualifying asset. It means what, sir? We can simply identify that borrowing. We can easily calculate the interest cost. So simply you capitalize that. For suppose if you invested the proceeds of the specific borrowing temporarily anywhere, we should reduce that temporary income and net amount only we should capitalize. Let me discuss this. For suppose we have taken a loan, that is specific borrowing, on 1st April 24, 10 lakh rupees. At the time of loan only, we paid 5 lakh rupees for construction, and remaining 5 lakh we are going to pay on 1st October 24. So in this 6 months, I parked this remaining 5 lakh in fixed deposit as an investment. Okay. So now how to deal with this? Standard is saying that first to calculate the gross borrowing cost. How much it is? 10 lakh into, let's assume it is 10%. You will get 1 lakh, correct? From that reduce interest on fixed deposit. It is 5 lakh into, let's assume this is also 10% for convenient purpose. This is 6 months, correct? So how much it is? 5 lakh into 10%, 50,000, 25,000. So this 75,000 you capitalize. Okay. And one more thing. For suppose our construction completed on 31st December. Construction completed on 31st December. That specific borrowing is still outstanding. It means what? After 31st December, That specific borrowing is general borrowing, not a specific borrowing. Okay. Till 31st December, it is a specific borrowing only. We should directly capitalize. After construction, it joins in the category of general borrowings. Clear? And next one, general borrowings. You should very careful about this. It is very tricky in exams. Okay. What is general borrowings? We can say it is not a specific borrowing. Simply we can say, for suppose in our balance sheet there are three loans: 12% term loan, 10% debentures, 8% working capital loan. So these loans are not specific, correct? We cannot map this one to one to the qualifying asset. They are general. So in that case, how to calculate the borrowing cost that can be capitalized? That is our discussion. Standard is saying that simply you calculate the capitalization rate first. Capitalization rate means what? You take the total interest cost on general borrowings. We should not consider interest on specific borrowings in these calculations. Okay. You take the total interest cost on general borrowings and divided that amount with weighted average general borrowings outstanding during the period. For suppose if any borrowing that is outstanding throughout the period, that borrowing amount into 12 by 12. For suppose we issue debentures on 1st July 2024. It means what? The debentures are outstanding for next 9 months during the financial year. So you multiply like this 9 by 12. I should be very careful with the denominator. Okay. That is capitalization rate. And thereafter in step 2, see here, step 1 we calculated capitalization rate. In step 2, calculate the weighted average expenditure incurred on qualifying asset. Weighted average expenses. For suppose we incurred 5 lakh rupees on qualifying asset as an expense on 1st April. It means what? For next 12 months of the same financial year, it is outstanding. So multiply that amount into 12 by 12. For suppose we incurred one more expense on 1st July. It means what? It is outstanding for next 9 months. So 9 by 12. Similarly, if we incur expense on 1st January 2025, it means what? It remains 3 months outstanding for the same financial year. You multiply with 3 by 12. So that total amount you find, you apply the capitalization rate on that amount, not on outstanding borrowings. What I am saying, we should apply this capitalization rate on expenses that we calculated. See this, step 2. I can say that step 2 into step 1 simply. The next step, step 3 is what? You calculate the step 2 into step 1. You compare that amount with actual borrowing cost incurred on general borrowing. It is nothing but numerator in capitalization rate. See here, numerator. Again, I am repeating. In first step, calculate the capitalization rate. In second step, calculate the weighted average expense. In third step, you multiply the step 2 and step 3. That is going to be your interest cost on general borrowings that is eligible for capitalization. Before concluding, you should compare the number of this step 3 with the actual borrowing cost, and lower one should be the amount that can be capitalized. Okay. Sir, in step 2 we discussed that weighted average expense incurred on qualifying asset that we calculate. So what are all the expenses we consider in that? Standard is saying that expenditure that have resulted in cash payments only. It's not accrual basis. Okay. And transfer of other assets. For suppose we are constructing a building, that is a qualifying asset. We are having cement bags in our godown, cement bags. So we are using that cement bags. We are transferring that assets, correct? So you add that. And if you assume any liabilities, interest bearing liabilities for construction of that qualifying asset, you include it. And from that reduce any grants received, government grants or any other grants received, and also progress payment received. So that ultimate amount will become your step 2. Multiply that step 2 with step 1, that is capitalization rate. In step 3, you will get one amount. You compare that amount with the actual borrowing cost incurred on borrowings, general borrowings. The lower of the two amounts will become your borrowing cost that can be eligible for capitalization. Clear? And one more thing I would like to tell you is, for suppose we are in second financial year. For first financial year, it is very simple. That what we have discussed. In second financial year, in step 2, we should start with opening balance. It means what? Carrying amount of qualifying asset. Whatever the expenses we added in step 2 of financial year, that amount you take all amounts. For suppose In our discussion, we incurred on 1st April one expense, 1st July another expense, 1st January another expense. So you all these expenses for suppose 15. And what is the borrowing cost that we capitalize as per step 3 in first year that you add? Okay, so this total amount will be the first amount you consider in calculation of weighted average expenses incurred during the second year. Okay, so this is going to be the starting point of your step number 2 in second financial year or subsequent, if any. Same process we should repeat. Clear? And next one, capitalization of borrowing cost in group financial statements. For suppose there is a group of companies. Parent company took a loan from bank. Subsidiary company is constructing a qualifying asset. In separate financial statements of parent company, we should not capitalize interest cost because parent company is not constructing any qualifying asset. It is having a borrowing. It is incurring interest cost that should be charged to profit and loss account. In subsidiary company, books of accounts, separate financial statements, qualifying asset construction is going on, but subsidiary company don't have any borrowing. We should not capitalize anything because subsidiary companies don't have any borrowings. However, in consolidated financial statements, from group point of view, there is a qualifying asset, there is a borrowing. So we should think appropriately whether that borrowings and qualifying assets can be capitalized. Okay, from group point of view, it is appropriate to capitalize the borrowing cost. Because from group's point of view, we need to see all companies as a whole, one company only, right? We should capitalize it. However, if parent company has not taken any loan from outside bank, parent company given a loan from its own funds to subsidiary, and subsidiary is constructing qualifying asset. In that case, in subsidiary company separate financial statements, you can capitalize. However, from group financial statements, intercompany transactions eliminated, correct? So there is no loan, no interest, no capitalization. The next one is cessation of capitalization for matured inventories. Some kind of inventories like grapevine, whiskey, they takes long period of time to become mature. In fact, it is difficult to determine a point of time at which maturation process is completed. If the entity can demonstrate that maturation process is still in progress, we can continue to capitalize the borrowing cost. Otherwise, we should stop the capitalization of borrowing cost. That is what the standard is saying. Okay. So with this, our discussion on Ind AS 23 is completed. As we know, this standard is applicable to all intangible assets. However, there are some exceptions. What they are? Intangible assets covered by other standards. For suppose, leases of intangible assets. Intangible assets held for sale in the ordinary course of business means what? They are inventories to that particular entity and they are covered by Ind AS 2. Consequently, they are scoped out of Ind AS 38. These are just an examples. Other intangible assets that are covered by other standards are also scoped out of this standard. Clear? And financial assets, as we know, there are big standards to deal with financial assets. They are also scoped out of this standard. And exploration and evaluation assets, expenditure on development and extraction of minerals, oil, natural gas, and other similar resources. These are also scoped out of this standard. But note that if any intangible asset that is covered by this standard is used for point number C and point number D, I can say that for mining business, so that intangible asset is covered by Ind AS 38 only, not covered by these standards. Clear? And one more thing, if any rights granted under licensing agreements for items like motion picture films, video recordings, plays, manuscripts, patents and copyrights are covered by Ind AS 38 only. They are not covered by Ind AS 116 leases. Clear? And coming to the definition of intangible assets, standard is saying that it is an identifiable non-monetary asset without physical substance. Identifiable non-monetary asset without physical substance. Very simple and single line of definition. Correct? But In order to identify an asset as an intangible asset, firstly we need to understand what is the meaning of identifiable asset and what is non-monetary asset and what is the concept of physical substance. Correct? So let's discuss one by one. Firstly, identifiable asset. An asset is said to be identifiable if it belongs to either of these two criteria. First one, if that asset is separable, yes, we can say that it is an identifiable asset. Separable means what? We can separate it from the entity. We can divide it from the entity either by sale or exchange or transfer, either individually or together with other related items. For suppose we are having some patent rights and software. Can we sell that? Yes, we can sell. We can transfer. We can exchange, correct? So we can say that these are separable. For suppose internally generated goodwill. Can we sell that? Can we transfer that? No. In order to sell internally generated goodwill, we should sell our entire business. So that is not separable. So we can say that internally generated goodwill is not an identifiable asset. And one more thing, if an asset, even that asset is not separable, we can say that that is an identifiable asset if that asset arises from any contractual or legal rights. The best example I can tell you is telecom licenses granted by the government and mining rights as well, because this comes from contractual or other legal rights, right? And what is non-monetary asset? As we discussed, intangible assets are non-monetary asset. We studied in Ind AS 21, correct? What is monetary asset and what is non-monetary asset? Monetary asset means what? These are the asset from which holder entitled to receive fixed or determinable amount of money. For example, trade receivables, correct? From trade receivables, we are entitled to receive fixed amount of money. If you take plant and machinery as an example, can we get fixed amount of money from plant and machinery? May or may not. Majorly, I can say no. No is the answer. Because we derive economic benefits from usage of the plant and machinery. It may or may not equals to fixed amount of money. From this discussion, I can say that non-monetary asset is an asset that does not entitle the holder to receive fixed or determinable amounts of money. So that is non-monetary asset. Or intangible asset is also non-monetary asset. What is the meaning of asset first? We are studying this from CA foundation level, correct? What is an asset? Basically, it is a resource controlled by the entity as a result of past event. From that resource, future economic benefits are expected to flow to the entity. That is an asset. What is the meaning of control? Because we said that it is a resource controlled by the entity, correct? What is control? Control means, on one hand, entity should have the ability to get the economic benefits from that particular asset. On the other hand, entity should have the capacity to restrict others from accessing that particular asset. Then only we can say that an entity is having control over that particular asset. Clear? One example I can tell you. For suppose generally companies provide staff training, correct? Companies provide training programs to their employees in order to increase their efficiency. Thereby company gets the economic benefits, right? So in this story, definitely company incurs staff training cost. The question is, can we recognize that staff training cost as an asset? We should not. Why? Because we are not having the control over that employees. We are not having the control. Why? Employees can resign. Employees can choose other employers, correct? On the other hand, we don't have the ability to restrict other employers as well to hire them, correct? So we can say that staff training cost is not an asset. And what is the meaning of economic benefits? Economic benefits means because of that particular asset, we are able to generate the revenue either by sale of goods or for providing services. And also, we may save the cost because of that particular asset. We are able to cut our cost, or simultaneously both can happen, or any other benefits that we get from usage of that particular asset. So these are economic benefits. Are you clear with this? And coming to the physical substance, as we discussed, intangible assets is a non-monetary, it is identifiable non-monetary asset without having physical substance. It means what? It is by their inherent nature, they don't have the physical substance. However, some intangible assets contained in physical substances, physical devices. So it means what? They are having both tangible elements as well as intangible elements. So in that kind of situations, how to decide whether it is a tangible asset or intangible asset? Standard is saying that it is a subject matter of judgment. It is completely based on judgment, and we should consider which element is more significant. If tangible element is more significant, definitely it is not an intangible asset. If tangible element is not significant, I mean intangible element is more significant, in that case we can say that it is an intangible asset. Correct? For example, we store the software in disk or pen drive, correct? So pen drive is not significant, software is significant. So that is an intangible asset. Similarly, for suppose we are a pharmaceutical company and we are having some patent rights or licenses in connection with our medicine. So where we store that patent rights? We code in legal paper, correct? So that legal paper is not significant. Our right, our license is significant. So we can say that it is an intangible asset. Clear? And one more thing, computer software. If computer software is an integral part of hardware, in that case, we should recognize that entire system as tangible asset only. That's why we see computer or laptop in property, plant and equipment classification. Correct? Best example is operating system, our Windows, for suppose. Can we run our computer without Windows? No, it is an integral part. So we should recognize it as property, plant and equipment. And other softwares like antivirus software, artificial intelligence tools, without them we can run our machine, correct? So we can recognize them as intangible assets. Are you clear with this? So still now we have discussed about scope of the standard and definition of intangible assets, correct? So once an asset satisfies the definition of intangible asset, subjected to scope of the standard, if that intangible asset satisfies this recognition criteria, we can recognize that as an intangible asset in the books of accounts of the company. What is the journal entry for that? Intangible asset account debit to bank or vendor account. Right? So what is the recognition criteria? It is probable that means what? More likely to happen. I can say that more than 50% chances that future economic benefits that arise from that particular intangible asset should flow to the entity, and the cost of that intangible asset can be measured reliably. If these two conditions are satisfied, yes, you pass that journal entry. You recognize that, no problem. Are you clear with this? And one more thing I would like to tell you is, all these points, all these expenses we should not capitalize, and this is very important for your examination point of view. Correct? What I am saying, all these expenses we should not capitalize. We should charge to profit and loss account as an expense. So what is that? First one, expenditure on research. It means what? Research expenses. Research expenses we should not capitalize. However, there is one exception. What is that? In case of business combination transactions, on the date of acquisition, if acquiring entity is having any in progress research expense, that we can capitalize on the date of acquisition. After acquisition, if we continue that research, obviously we incur a research expense, correct? So that research expense we should not capitalize. I hope you are clear with this, correct? And next one is expenditure on startup activities. These are initial inauguration type expenses that we should not capitalize. Expenditure on training activities, we already discussed with good example. Training costs we should not capitalize. Expenditure on advertising and promotional activities, they are operating in nature, so we charge to profit and loss account. Expenditure on relocation or reorganizing part or whole of the entity, operating in nature, charge to profit and loss account, right? So what we have discussed till now, scope of this standard and recognition principles. Yes, our intangible asset satisfies the definition of intangible asset as well as recognition criteria. That is fine. Now we pass it the journal entry for recognizing intangible asset account debit to bank or vendor account. This is fine. Till now we have discussed at what amount that intangible asset should be recognized. That is our next discussion. So standard is saying that recognize at cost only. Recognize that intangible asset at cost only, no other amounts. Sir, how to determine the cost? It is completely based on mode of acquisition of intangible asset. How you acquired that intangible asset? Whether you acquired a ready-made intangible asset that is available in the market, or you acquired in connection with business combination transaction, or you got any government grant in connection with intangible asset, or it is internally generated goodwill or internally generated other intangible asset. or you acquire that intangible asset by exchanging your own intangible asset. So we will discuss that cost, that amount for each case one by one. Okay, let's start. First one, separate acquisition. Separate acquisition means what, sir? There is a ready-made intangible asset available in the market. We are purchasing that either on cash or credit basis. That's it. So standard is saying that purchase price you capitalize, non-refundable duties and taxes you capitalize. If they are refundable in nature, we should not capitalize. And don't forget, reduce the trade discounts and rebates, but cash discount we should not reduce. And one more thing, any directly attributable cost we can capitalize. Directly attributable cost means what? These are the costs we should incur in order to get our intangible asset for intended condition. Okay, I mean intended working condition. Right? So that is the cost we should capitalize. Standard has given few examples for that. Have a look. Employee benefit costs, salaries and wages that are directly related to bring that asset to the working condition, we can capitalize. Professional fees. In order to make it working condition, we may need professional consultation. So whatever the cost we incur, recognize, capitalize. And cost of testing, these are basically trial run expenses that also we can capitalize. And these are the examples that are not directly attributable costs. What they are? Cost of conducting the business, they are operating costs, charge to profit and loss account, administration and other general overheads expense. And next one, cost incurred in introducing new product or service. What means? It is an advertisement expenses or promotional charges. So charge to profit and loss account, all these expenses, because they are not directly attributable costs. And one more thing, payment deferred beyond normal credit term. What does it mean? Simply, I can say that generally credit period is all about 15 days, 30 days, 45 days, 60 days. Hardly it is 3 months, correct? Beyond that, for suppose, if we acquire an intangible asset, for that we are going to make the payment at the end of second year, let's assume. It means what? It is, obviously it is a abnormal credit period purchase, correct? So that purchase consideration, whatever the amount we are going to pay to the vendor includes interest cost. So that interest cost we should not capitalize. We should charge to profit and loss account as an expense. That is fine, sir. Then what about initial recognition amount? In that case, standard is saying that initially recognize at cash price only. Cash price means what? If we purchase that intangible asset on cash basis, how much amount we need to pay on the date of acquisition? So that is the cash price. If cash price is not available in the question, you calculate the present value of future payments. How much amount we are going to make the payment at the end of second year. To that amount, you calculate the present value today. So that is the amount at which you can initially recognize. Right? Sir, we are discussing about what are all the costs that can be capitalized and what cannot be capitalized. That is fine. How long we should capitalize? Is there any point after which we should cease the capitalization? Yes, standard is saying that. Once an intangible asset is in the intended condition, any cost incurred thereafter, we should not capitalize. We should expense to profit and loss account. So that is what the standard is saying. Are you clear with this? And next one is, these are the examples standard has given for that. Have a look once. Cost incurred in using or redeploying the intangible asset. Means what? They are operating expenses. Second one, what is this? For suppose, on 1st July 2025, our intangible asset is in the intended condition. On 1st October 2025, entity put that intangible asset for usage. So out of these two dates, which date is relevant? 1st July 2025 only. So any cost incurred after 1st July 2025, we should not capitalize. 1st October 2025, it is not relevant. Right? It is not relevant. It is a just trap to confuse you in the exam. Okay? And next one, initial operating losses, we should not capitalize. Charge to profit and loss account as an expense. Okay? Anyways, it is a loss. Right? So with this, our discussion on how to determine the cost for acquisition of a ready-made asset is completed. Right? We determine that cost. Now you recognize intangible asset account debit to bank account. You write that amount. That's it. And next one is acquisition of intangible asset as a part of business combination transaction. Okay, in this case, for suppose we are X Limited and there is a company Y Limited. We are acquiring that Y Limited. Okay, we are acquiring that Y Limited. For that we are paying purchase consideration and we are getting their net assets. This is the story. For suppose on the date of acquisition, if Y Limited is having any intangible asset, recognize that intangible asset at fair value. That is the first point. Second point, if Y Limited is having intangible asset exists, but it is not reflected in the books of accounts of Y Limited due to any reason. For suppose Y Limited is a pharmaceutical company and it is having some patent rights. Because the company is not going to get any future economic benefits from that particular patent rights, the company written off that patents. Because of that reason, that patent is not appearing in the books of accounts of the Y Limited. Now, at the time of acquisition, we got to know that patent exists, but it is not reflected in the books of accounts of Y Limited. No problem, sir. You recognize that patent right also separately from goodwill if that patent right satisfies the recognition criteria. Are you clear with this? Why should we recognize that patent right separately from goodwill? Because if we don't recognize that patent as a separate intangible asset, what will happen? Fair value of net assets will reduce and thereby goodwill amount will increase. So it will sit in the name of goodwill and that goodwill we cannot amortize. That goodwill sit permanently, correct? That goodwill sit in our balance sheet permanently. So that is the reason behind why we should recognize that patents, that intangible asset not appearing in the books of accounts of Y Limited, we should recognize separately. Are you clear with this? And next one, for suppose there is a in progress research and development cost in the books of Y Limited. So that in progress research and development cost can also be recognized as a separate intangible asset. It means what? We can capitalize that only if that research and development project satisfies the definition and recognition criteria of Ind AS 38. So have you noticed one thing? We should recognize all these intangible assets separately from goodwill. Correct? Why? As I already said, if we don't recognize them as separately, what will happen? They will sit in the name of goodwill. So goodwill balance increases. That will sit in the balance sheet forever because we cannot amortize the goodwill. I hope you are clear with this. Correct? So with this, our discussion, one more point is there. For suppose, if Y Limited is having some complementary assets like brand name, trademark, logo, these are complementary assets. Complementary asset means what, sir? They work together to generate the economic benefits for the company. So here, brand name, trademark, logo, they are basically work for one objective only, correct? So what the standard is saying that you recognize all that kind of assets as a single asset on the date of acquisition only if that assets are having similar useful life. Okay, they are having similar useful life. See here, similar useful life. Complementary assets, complementary intangible assets with similar useful life may be recognized as single assets. Right? You are clear with this. And next one is acquisition by way of government grant. For suppose if the entity receives any government grant in connection with acquisition of intangible asset, basically that is the subject matter of Ind AS 20. Anyways, we are going to cover separately in separate session. For the time being, you remember that. Recognize that intangible asset at fair value. No, sir, I don't want to recognize at fair value. No problem, you recognize it nominal amount. Nominal amount means what, sir? 1 rupees, 10 rupees, 100 rupees, like that. In addition to that nominal amount, any expense that is directly attributable to that intangible asset also we can capitalize. That's it. This is all about acquisition of intangible asset in connection with government grant. Okay. And next one is exchange of asset. We are acquiring intangible asset by exchanging our own asset. So in exchange transaction, what we do first? For suppose intangible asset A is our asset, intangible asset B is no. Intangible asset is that we are acquiring, intangible asset B is that we are given up. Okay, intangible asset A is we are acquiring, B is we are given away. Right? So this is the example. So what is the journal entry we write for this? We should de-recognize our asset for suppose. For suppose we are exchanging our assets. Okay, what we need to do first? We should de-recognize our asset first. What is our asset? B is our asset. We are de-recognizing at carrying amount. Now we should recognize the asset that we are acquiring, correct? We are acquiring intangible asset A that we are acquiring. At what amount that asset should be recognized? That is our discussion. So standard is saying that you check whether two conditions exist or not. What that conditions? Whether this exchange transaction is having commercial substance or not, and fair value of either of those assets can be measured reliably or not. If these two conditions are satisfied, yes, you can recognize this asset at fair value. No problem. You can recognize that asset at fair value. Fair value, okay. Which asset fair value? Either asset that we are given up or asset that we are acquiring. Standard is saying that first preference you should give to fair value of asset that we are given up. Second preference, fair value of asset that we are acquiring. That's it. One more thing here. If fair value of asset that we are acquiring is more clearly evident than compared to fair value of asset that we are given up, in that case, recognize at fair value of asset that we are acquiring. That is what the standard is saying. So, in this case, accounting is completely based upon two conditions, correct? Commercial substance and fair value. Fair value is fine. What is the meaning of commercial substance? Commercial substance means because of that exchange transaction, how our future cash flows are expected to change. How to determine that? Simply, you check the configuration of cash flows of assets that we are given up and configuration of cash flows of asset that we are acquiring. If the configuration of cash flows are different, in that case, we can say that there exists a commercial substance. Clear? Configuration of cash flows means what? It's nature, timing, risk, amount of cash flows. That's what. For suppose we are having a software and they are having patent rights. We are exchanging. So there is a configuration of cash flows are different. So there exists a commercial substance. For suppose we are having some software A, they are having some software B. We are just exchanging. Both are same. So in that case, there is no commercial substance in terms of configuration of cash flows. In other way, we can check the entity specific value for that two assets. Entity specific value. Entity specific value means what? It is the present value of post-tax cash flows that generated by that particular asset. If the entity specific value of the two assets is different, yes, you can say that commercial substance exists. Right? So what are the journal entries? For suppose there is no cash involvement is there, as we already discussed. Firstly, you de-recognize your own asset at carrying amount, recognize the asset that we are acquiring at fair value. Fair value preferences we already discussed. First preference is asset given up. Second preference is asset that we are acquiring. If fair value of asset that we are acquiring is more clearly evident than compared to fair value of asset that we are given up, in that case we should recognize it fair value of asset that we are acquiring. So any difference between these two amounts, you charge to profit and loss account. You recognize to profit and loss account, be it a gain or loss. Okay. If cash involvement is there, that skeleton entry as it is you write, de-recognize it carrying amount, recognize it fair value. If you are paying, credit that amount. If you are getting, debit that amount. Difference you recognize in profit and loss account. That's it. For suppose, sir, as you said, commercial substance should exist and fair values of either of those assets can be measured reliably. If these two conditions are satisfied, yes, we discussed that accounting. If either of those conditions not satisfied or both conditions not satisfied, in that case, how to do the accounting? Standard is saying that you do the accounting in such a way that there will be no gain, no loss. See here the journal entries, you will understand. For suppose cash involvement is not there. Firstly, you de-recognize your own asset at carrying amount and recognize the asset that you are acquiring at carrying amount of your asset. At carrying amount of your asset, I mean the asset you are given up. In our example, intangible asset A is the acquiring asset, intangible asset B is the asset that we are given up, correct? So this carrying amount of intangible asset B. This is the carrying amount of intangible asset B. Means what? Carrying amount of intangible asset that we are given up. That is the amount at which we should recognize the asset that we are acquiring. Clear? For suppose cash involvement is there. In this case, this will become the balancing figure. The asset we are acquiring will become the balancing figure. Cash involvement is there. As usual, you de-recognize your own asset at carrying amount. After that, if you are receiving the payment, debit it. If you are paying the payment, credit it. This will become the balancing figure so that no gain, no loss can be recognized. Right? So with this, we are completing our discussion for determination of cost for all these modes of acquisition. Correct? Is there anything left? Yes. One more thing is there, correct? What is that? Internally generated goodwill and internally generated intangible assets. About internally generated goodwill, we have already discussed at the time of discussion of definition of intangible asset, correct? Internally generated goodwill is not separable. So it is not an identifiable asset. So it is not satisfying the definition of intangible asset. So we should not recognize internally generated goodwill. Then what about other internally generated intangible asset. Standard is saying that yes, we can recognize other internally generated intangible asset only if they satisfy the additional recognition criteria. And standard is divided the generation process into research phase and development phase. Whatever the cost we incur during the research phase, we should charge to profit and loss account as an expense. We should not capitalize. And development expenses we can capitalize if the development process fulfills the recognition criteria. I mean the additional recognition criteria. If the entity cannot differentiate between what is the research phase and what is development phase, all expenses that we incurred should be treated as research expense only. It means what? We should not capitalize. That is what the standard is saying. And one more thing, other internally generated intangible assets like brands, mastheads, publishing titles, and a customer list, these do not qualify for recognition of intangible asset. Why? Some of these kind of assets don't satisfy the definition of intangible assets. Some are satisfying the definition of intangible assets, but they are not satisfying the recognition criteria, especially due to we are not able to measure their cost. So this kind of intangible assets we should not recognize. So let's discuss what is research phase and what is development phase. Research phase means what? It is an investigation. Research is nothing but an investigation to acquire a new knowledge or new understanding, maybe about a new product or service, or for improvement of existing product or service or system or process, whatever it may be. So whatever the expense we incur during the research phase, we should not capitalize. We should charge to profit and loss account as an expense, even if that research is going to be successful. Why we should expense? Because from research phase, it is not probable that we are going to get any economic benefits unless research is successful and development phase start, and development phase is also successfully completed. We cannot get any future economic benefits, correct? So that is the reason behind why we should not capitalize research expenses even it is successful in future, right? And coming to the development phase means what, sir? Basically it is application of knowledge that we got, application of result that we got from the research phase, be it either for designing a new product or service or improvement of existing product or service or system process, as the case may be. This story is all about before they are commercially produced, before they are commercially used, correct? So what we discussed, yes, any expense that incurred during the development phase can be capitalized only if that satisfies all these 6 conditions. What they are? Entity should prove that it is technically possible to complete the intangible asset for making it available for use or sale, and entity should have the intention to complete, and after completion it should use it and sell it. Okay, it should have the intention to use it or sell it after completion. Not only intention, sir, entity should also have the ability to use or sell it after completion. And in addition to this, entity should have the adequate resources to complete the development process, be it a financial resource or human resource or any other infrastructure or any other resource that is necessary to complete the generation process. And 5th condition and 6th conditions are general requirements only. What is that? Entity should show that how intangible asset will generate the future economic benefits, and that development cost we should measure reliably. If all these conditions are satisfied, yes, we can recognize, yes, we can capitalize the expenses incurred during the development phase. Are you clear with this? And one more thing is, for suppose on 1st April 2025, we are starting the development phase. It means what? Just because we are starting the development phase on 1st April 2025 doesn't mean all conditions are not satisfied. All conditions are satisfied. If all conditions are satisfied on that date, any expense we incur thereafter, we can capitalize. For suppose, one more example. On 1st April 2025, we are starting development phase. On 1st October 2025, all 6 conditions satisfied. So in this case, which date is relevant for starting capitalization? 1st October 2025 is relevant. So whatever the expense we incur during the period 1st April 2025 to 1st October 2025, that we should not capitalize. We should charge to profit and loss account. That's it. Right? And after 1st October 2025, any expense we incur, we can capitalize. Okay. And one more thing is, expense that previously we charged to profit and loss account should not be capitalized because 6 conditions are satisfied, right? See here, note point. If any development expense is charged to profit and loss account, due to non-fulfillment of any condition, it can never be capitalized again, even if conditions are satisfied subsequently. That is what the standard is saying. And one more thing, we discussed that when should we capitalize the expense and when we should not capitalize the expense. That is fine. What kind of expenses we can capitalize and what kind of expenses we should not capitalize. That is the discussion. So what standard is saying that all directly attributable costs, for that development phase in order to generate the intangible asset can be capitalized. This is very similar to self-construction of property, plant and equipment, sir. I can say this is very similar to self-construction of property, plant and equipment. So see here the examples. Cost of materials, services used, consumed in generating the intangible asset. Yes, they are very, very essential to capitalize it. Cost of employee benefits, salaries and wages that are directly connected with the development process, you capitalize it. Fees to register a legal right. Okay, for intangible asset, we should register with government authorities, so that cost you can capitalize. Amortization of patents and licenses that are used to generate the intangible asset. In order to generate our intangible asset, if you use any patent or licenses, amortization charge of that patents and licenses can also be capitalized. That is what the standard is saying. And cost exclusions, you can express this. You can guess this: selling expenses, administration expenses, other general overhead expenses we should not capitalize. And cost of identified inefficiencies or initial operating losses, this should not capitalize, and staff training costs also, that we should not capitalize. So till now what we have discussed is about only to the extent of passing that journal entry, intangible asset account debit to bank or cash account amount. So we determined the amount for different modes of acquisitions. Now we initially recognized our intangible asset. That is over. So what next? After such initial recognition, if we incur any subsequent cost, after that initial recognition, if we incur any subsequent cost, that cost also be eligible for capitalization if it generate additional future economic benefits. Otherwise, you charge to profit and loss account as an expense. That's it. So until now we have discussed about initial recognition and subsequent cost. Correct? So next one is, at what amount we should carry our intangible asset for the end of reporting period or for subsequent periods. So that is our discussion. Standard is saying that for that subsequent measurement, either you can follow cost model or revaluation model. Whichever model you are going to follow, that will become an accounting policy, and that policy we should apply consistently to the entire class of intangible asset. Class of intangible asset means what? Assets are having similar nature and similar usage. For suppose we are having software and patent rights, they are not having similar nature and similar usage, correct? So you can apply different models for that. For suppose we are having three softwares, software A, software B, software C. These are all having a similar nature and usage, correct? These softwares are all having similar nature and similar usage. So in this case, you should apply either cost model or revaluation model. Only one model you should apply. For suppose, if you are following revaluation model for all that three softwares, if we are following revaluation model for all that three softwares, for suppose software C is having no active market. In that case, standard has provided one exception. No problem. For first two softwares, you can follow the revaluation model. For third software C, you can subsequently measure at cost model. As per cost model, you can subsequently measure that software C. For suppose we are successfully revaluing that asset. For suppose we are in fourth year. In fourth year, one software is not having active market. So in that case, no problem. You can measure at previously revalued amount minus subsequent amortization minus subsequent impairment loss. That is what the standard is saying. In that case, we should go for impairment testing because it is indicating, correct? It is one of the indication of impairment testing. So we should go for impairment in that case. And one more thing I would say that till now we have applied cost model for subsequent measurement of our intangible asset. But now I want to apply the revaluation model. Can I say this is a change in accounting policy? Yes, it is a change in accounting policy. So what the standard is saying that in this case, retrospective accounting is not required. You apply the revaluation accounting prospectively and that is sufficient. That is what Ind AS EIT is saying, right? So coming to the calculation part, at what amount we should recognize our intangible assets. In case cost model, simply you write the amount that we determined on initial recognition. From that, reduce the accumulated amortization. If there is any indications of impairment exist, you calculate the impairment loss, you reduce that, resultant amount will become your carrying amount. If it is a revaluation model, simply you write the fair value on the date of revaluation. From that, reduce the accumulated amortization subsequent to revaluation date. We should not reduce accumulated amortization prior to revaluation date. Okay, and the same with impairment loss. Resultant amount will become your carrying amount, at which you can carry your intangible asset in your books of accounts. I mean the balance sheet. Okay, sir, just because you are following revaluation model doesn't mean you should go for revaluation every year. Standard is saying that if fair value fluctuations of your intangible asset is significant and volatile, then only you go for annual revaluation. Otherwise, you should not go. Revaluation once in 3 years or once in 5 years is suffice in that case. Okay, at the time of you are going for revaluation, you decided that be it annual or once in 3 years or once in 5 years. At the time of you are going for a revaluation, on that date, if you find that carrying amount of your intangible asset is not materially different from your fair value of the asset, in that case revaluation is not required. This is the primary objective of revaluation model. See here, revaluation model primary objective is what? To ensure that carrying amount of intangible asset does not materially different from fair value. So what I said, on the date of revaluation, if your carrying amount of intangible asset is not materially different from fair value of your intangible asset, in that case, revaluation is not required. If it is materially different, yes, you should go for revaluation. So that is what the standard is saying, right? And after revaluation, yes, it is materially different, you revalued. Even after revaluation, the carrying amount of your intangible asset is materially different from fair value, you go for further revaluation. So that is what the standard is saying. Right? So how to deal with revaluation accounting? If it is a first time revaluation and that gain on first time revaluation we are getting a gain, recognize in OCI section that will accumulated in equity under the heading revaluation surplus. If it is a loss, charge to PRL section, that's it. And subsequent revaluation, earlier there is a gain, now also gain, simply you do the same. Recognize in OCI section, it will accumulated in equity under the heading revaluation surplus. There is a loss, before there is a loss, now also loss, so charge to PRL. There is a gain, last time there is a gain, now it is a loss. Simply you recognize this loss in OCI section to the extent of previous revaluation surplus. If any loss still exists, that you charge to PRL section. That's it. Earlier there is a loss, now it is a gain. It is quite opposite to previous one. So this recognize this gain in PRL section to the extent of previous revaluation loss. Any gain still exists after that, you recognize in OCI section. And we are having one more obligation. If we are following revaluation model, at the time of derecognition of intangible asset, if any revaluation surplus balance exists in respect of that particular intangible asset, we should transfer that amount from revaluation surplus to retained earnings. Revaluation surplus to retained earnings. Or alternatively, at the time of derecognition, is not required. Every year you do that to the extent of additional amortization due to revaluation. So as you know, if we get any revaluation gain, thereafter definitely our amortization charge will increase, correct? So what the standard is saying that to the extent of that increased portion, to the extent of that additional amortization charge, you transfer from revaluation surplus to retained earnings every year. This is alternative and this is first one, and this is the alter. And how to deal with accumulated amortization account in case of revaluation? Standard has provided two alternatives. First one is you simply eliminate the balance in accumulated amortization account. You adjust that balance with the gross carrying amount of intangible asset. And second one is restatement approach. So let's discuss with numbers so that you can get good amount of clarity. For suppose initial cost 1 lakh rupees, accumulated amortization 55,000 rupees. It means what? Our carrying amount is 45,000 rupees, correct? So fair value is 65,000 rupees on the date of revaluation. It means what? 20,000 rupees our revaluation gain. So in this case, first method, elimination of accumulated amortization balance, right? You eliminate it. See the journal entry, we are eliminating the accumulated amortization balance that we are directly adjusting to gross carrying amount of intangible asset, correct? and you simply recognize the revaluation gain. See here, we are recognizing the revaluation gain. That's it. Then what about restatement approach? In case of restatement approach, what we should do is we should calculate the percentage of change. I can say percentage of that revaluation surplus or revaluation deficit to the carrying amount of that particular intangible asset. And you adjust the gross carrying amount of intangible asset as well as accumulated amortization account to the extent of that percentage. See the journal entry, you will get good amount of clarity. Here intangible asset, it is having a gross carrying amount of 1 lakh rupees, correct? So you increase. In our example, this is revaluation gain. So you increase to the extent of that percent. So we are increasing. And similarly, you reduce that accumulated amortization. Accumulated amortization also we should increase. See here, we are increasing. Accumulated amortization 55,000 into 44%. Because it is a revaluation surplus, we are increasing that balances. If it is a deficit, we should decrease. So that it will become 65,000 fair value. Fair value means what? After revaluation, it will become our carrying amount on the date of revaluation, correct? So this is the balancing figure and that will become our fair value gain. And next one is useful life. As you know, accounting for intangible assets is completely based on useful life, correct? If the useful life is indefinite, means what? How can we amortize? We cannot amortize. We should go for impairment test every year. If it is a finite useful life, it is having finite useful life, yes, we can amortize. So what is the meaning of intangible asset that is having indefinite useful life? I can say that that kind of intangible asset generate the economic benefits forever. There will be no foreseeable limit. If intangible assets are having a finite useful life, it means what? They generate the cash flows for a limited period. For suppose if intangible asset arises from any contractual or legal rights, in that case, useful life of that particular intangible asset should not exceed contractual period. It can be lower than contractual period, but it should not exceed contractual period. If the contract is having renewal option, yes, we can include that renewal period also in useful life, only when the cost of renewal is insignificant. If the cost of renewal is not significant, if the cost of renewal is significant, in that case, we should not include the renewal period in the useful life. Okay, are you clear with this? For suppose in business combination transaction, we are reacquiring our right. Before business combination, for suppose there is a Y limited and we are X limited. We transferred our, we are a brand restaurant in the market. We transferred a franchisee. We have granted a franchisee right to Y limited for 10 years, for suppose. And in this contract, we have granted a renewal option also after 10 years. This is the story. For suppose, at the end of 6th year, we are acquiring that Y limited. It means what? We are reacquiring the right that we have granted, correct? So, what standard is saying that? Useful life of that reacquired right is the remaining contract period. In our example, 4 years, correct? So, in this useful life, we should not include the period of renewal option. That is what the standard is saying. Now, you are clear with this, correct? And coming to the amortization, it is similar to depreciation charge for property, plant and equipment. What is it? Systematic allocation of depreciable amount of intangible asset over its useful life, and that amount we should charge to profit and loss account. That's it. What is depreciable amount? If it is a cost model, original cost minus estimated residual value. If it is a revaluation model, substituted fair value minus residual value. But note that in case of intangible asset, we should assume that residual value of intangible asset should be 0. However, there are exceptions. What they are? If there is a third party commitment to purchase our intangible asset at the end of useful life, or when there is an active market for that intangible asset at the end of its useful life. In these two situations, yes, we can take the residual value. In any other case, residual value will become 0. As we know, in this formula, residual value and useful life both are estimated, correct? They are estimations, not actual numbers. So what the standard is saying that at the end of each financial year, we should review that estimations, be it a residual value or useful life. In that process, if we noted that any change is there, that change should be accounted as change in accounting estimate as per Ind AS 8. And as we already know, we should charge the amortization when the asset is available for usage, not when the asset is actually put to use. That you already know, correct? And what about the method of amortization? The standard is not rigid about method of amortization. It should clearly reflect the pattern of consumption of economic benefits from that particular asset, and that method, our amortization method, should reflect that pattern. And we should apply that method of amortization consistently from one period to another period. For suppose, if you are not able to determine the pattern of consumption of economic benefits of that particular intangible asset, in that case, no problem. You follow the straight line method, that is sufficient. That is what the standard is saying. And for this method of depreciation also, we should review at the end of each financial year. On that review, if notice that if there is any change in pattern of consumption of economic benefits, we should change our method of depreciation also to reflect that changed pattern. And that change is also called as change in accounting estimate. We should treat that as a change in accounting estimate as per Ind AS 8. I can say that if economic benefits, consumption of economic benefits are uniform, you follow straight line method. If they decrease over a period of time, follow the written down value method. If they are linked with production units, you charge the amortization on the basis of units of production. Clear with this? And there is one exception. What is that? Generally, revenue based amortization is not appropriate. Amortization charge on the basis of revenue is not appropriate, but there is one exception. What is that? If intangible asset itself measured in terms of revenue, or revenue and economic benefits consumption both are correlated, in that case, we should go for amortization on the basis of revenue. The best example is, for suppose we have obtained a toll collection right from any national highway. Definitely we pay the cost. For suppose 50 lakhs is our cost of that right. And that right granted us to collect the toll charges to the extent of 2 crores. It means what? Our right is measured in terms of revenue only. Na? So in this case, we can charge the amortization on the basis of revenue. For suppose in the first year we collected 50 lakh, second year 60 lakh, third year 40 lakh, and next year some amount. You charge the amortization on the basis of proportion of this revenue. That is what the standard is saying, right? And next one is amortization of intangible asset will cease at the earlier of the following dates. What is that? When intangible asset is classified as held for sale or included in the disposal group, that is classified as held for sale. It means what? At the moment Ind AS 105 is applicable, that date or the date of derecognition of intangible asset, whichever is earlier. From that date, we should cease the amortization. And amortization charge is zero when we charging the amortization on the basis of units of production. For that particular year, when there is no production, amortization is also zero. And one more thing, residual value is greater than carrying amount. In this case also, amortization is zero. As we already discussed, residual value we should assume as a zero, except two cases. What that are? When there is a third party commitment to purchase the intangible asset at the end of its useful life, and when there is an active market at the end of the useful life. In these cases, we take the residual value number. If the residual value number is more than carrying amount, obviously there is no amortization, correct? So amortization will be zero, right? And now the favorite area came. What is that? Intangible asset with indefinite useful life. We are getting economic benefits for unlimited period. For everyone, this is favorite area only, correct? We should not amortize it. Instead of that, we should go for impairment as annually, and whenever there is indication that impairment conditions are existed. Are you clear with this? And one more thing, we are having one obligation in respect of this asset. At the end of each year, we should review this, whether the useful life is still indefinite or it changed from indefinite to finite. If it changed, we should treat that change as change in accounting estimate as per Ind AS 8. Are you clear with this? What I am saying, in process of reviewing whether the useful life of this intangible asset with indefinite useful life is changed or not, we found that it is changed from indefinite to finite. In that case, we treat it as a change in accounting estimate. That is what the standard is saying. And last one is derecognition of intangible asset. When we should derecognize the intangible asset? When disposed, when no future economic benefits are expected from it, you derecognize it. Derecognize it carrying amount. Difference between any sale proceeds. If no sale proceeds, total amount you charge to profit and loss account. That's it.